In this session, we are going to focus on certain basic conceptual aspects regarding the credit risk, where we will talk about first of all what are credit ratings and how does the credit risk link to these credit ratings. Then historically, what does the default probabilities, what is that the default probabilities are signifying, or what is that the default probabilities are conveying to us. Then we'll talk about the recovery rates and how the recovery rates are linked to default probabilities. The ways of estimating the default probability from the bond yield spread. How do I compare the different default probability estimates of two or more bonds or two or more instruments? How do I compute and compare the default probability estimates? Then, what is the way I can estimate the default probabilities using the equity prices? Here is where we'll try to introduce what is called as a Merton model, and then we move on towards the derivative transactions. How does the credit risk exist, and what are the various ways in which we mitigate the credit risk that is present in derivatives transactions, and we'll have a very broad level overview of what a default correlation means, right? All right. So whenever we talk about credit risk, it's one important risk for financial institutions. Okay, the other major risks that come into the category, they should be very much careful about the market risk. They should be careful about the operations risk. But of course, the credit risk becomes one of the most important aspects for financial institution. And what we see is they really go with a good number of resources. They invest in manpower, tools, for measuring and managing the credit risk. It becomes one of the high priority objectives for a bank to understand how much is the credit risk and come out with the measures and mechanisms to handle the credit risk. Even from the regulator's perspective, right, like the central banks of the country, they keep, they always mandate the banks to maintain certain amount of capital which would be in line with the kind of credit risk that they are taking. So there is the kind of a backup. Regulators always are stressing that the banks need to have sufficient backup associated with the kind of credit risk that they are taking. And whenever we talk about credit risk, there are two major dimensions that come up. The borrowers, bank is a major lender, right? So there is a possibility that the borrowers, in case of lending process, and counterparties, in case of a derivatives transaction, they default. And whenever they are defaulting, the parties which are on the other side, like the lender in case of the lending operation, or the bank in case of a counterparty, they are typically exposed to a risk, and that risk is what we are calling as the credit risk. Now, to assess the credit worthiness of the companies and the corporate bonds, there are what are called as a credit ratings which are given by companies like Moody's, S&P, Fitch. Moody's give a rating like this: A, AAA kind of stuff, AA, A, BAA, BA, B. And even within this, let's say right from the second grade till the last but one grade, or even the last grade, what they do is they have given something like AA1, AA2, AA3. Just again, in subdivision internally. Similarly, A1, A2, A3, BAA1, BAA2, BAA3. So some kind of a subgrading also they have given. And any bond with a AAA or AAA rating are considered to be more or less secured, no chance of defaulting. And anything that is above this, only these bonds are called as investment grade bonds, and these are called as speculation grade bonds, right? I can call as speculation grade bonds, or sometimes we call them as junk bonds. And so the same thing goes with S&P and Fitch. So up to here they are investment grade, I can map them one on one, and up to here they are speculative grade. And just like this 1, 2, 3 notation, here we have like AA plus, AA and AA minus, A plus, A minus, triple B plus, triple B, triple B minus. This is the kind of a subcategorization which S&P and Fitch give, which is more or less mapped on similar lines with that of Moody's. Only the highest and the lowest subcategories. So this is not graded, subdivided, and probably here we don't see this being subdivided. So that's how the credit ratings give a first-hand information with respect to the credit worthiness of the bonds as well as the company per se. Then, now let's start looking at the historical default probabilities. Historically, the statistics collected regarding the default of the investment grade bonds and the speculative grade bonds. What has been observed is when I look at the investment grade bonds and I am looking at the probability of default in a year, right? So if I take the time period here and probability of default here, it looks like it's an increasing function of time. Means initially the probability of default could be much smaller, but as the time is increasing, the probability of default is increasing. Why? Initially it's a good company. It is credit worthy. So today the probability of default is lesser. But as the time is elapsing more and more, there is a good chance that the performance of the company may deteriorate, and because of that, the financial health can decline, which will increase the chances of default of that particular kind of company. Whereas on the other side, when I look at a company with already a poor credit rating today, what matters is now. The criticality is to now and the next year or two. So what is typically seen is the probability of default, we are seeing it as a decreasing function of time. Because if it defaults, yes, it should default in the next year or two. But if it does not default and it has survived the initial couple of years, there is a good chance that its financial situation is improving. Otherwise, it would have defaulted by now. So historically, by looking at the data, this kind of conclusion can very well be made. So these kind of information has been dug out from the historical data. Then, hazard rate. If I have to introduce the word hazard rate, generally represented by lambda t, it is simply selected in such a way that lambda t times the delta t, which is the time period, which talks about the probability of default of a particular company or a bond between time period t and delta t, which means during the small time period delta t, we are talking about the probability of default. Based on that, we are computing this lambda t, and this is conditional on no earlier default. Right, assuming that the default has not occurred earlier, we are trying to find out what is the possibility that the default will occur between the time period t and t plus delta t. That is what we are calling as the hazard rate. And whenever we are using the word unconditional default probability in the nth period, I am always looking at what is the probability of default by the end of the n period minus what is the probability of default by the end of n minus 1 period. The difference between the two is going to give me the probability of default in the nth period. And a few more interesting equations. If I am looking at a variable called v of t, and if I am defining as cumulative probability that a company will survive up to time t, so the default between the time t and t plus delta t, it is like, okay, surviving up to time t is v plus t, v of t. Surviving up to t plus delta t is v of t plus delta t. The difference between the two is what it has defaulted between time t and t plus delta t upon the original, which is what is the v of t. This is what we compute as the probability of default between t and delta t. But at the same time, we said the probability of default between t and delta t, we already said that it is equivalent. We already said that it is equivalent. If you remember, the delta of t comma delta of t lambda of t times delta t, we already said it as the probability of default. So I'm looking at the change in value v of t plus delta t minus v of t. So because of that, I can equate this to minus lambda t delta t, or lambda t delta t is equal to v of t minus v of t plus delta t by v of t. So from here I can get v of t plus delta t minus v of t is equal to minus lambda t delta t vt. And now I can very well define q of t as the probability of default by time t. So this is the probability of survival. So by the time t, if it has to default, then it is 1 minus of e to the power 0 to t. I'm looking at the hazard rate, lambda of tau d tau. So from here I am very much getting that q of t is 1 minus e power minus lambda, the average hazard rate times t. And this hazard rate is also being called as a default intensity. So I can very well find out the average hazard rate between time 0 to t, from where I can be able to compute the default probability by the time t or between two time periods. All kinds of calculations can comfortably be done. Then we will introduce another term called recovery rate. See, whenever a company is defaulting, people or the organizations or institutions who have lent them, they can claim against the assets of the company. In some cases, there could be a reorganization where the creditors, they agree for receiving partial payments. In some cases, the entire assets of the borrower are sold by the liquidator and the proceeds are distributed to the lenders depending on their priority, depending on their seniority in the structure or depending on the kind of security or collateral that has been assigned towards that particular loan or borrowing. So the recovery rate in general, when I have to define, it's the market value of the instrument just a couple of days after default, and when I am expressing it as a percentage of face value. So I could say 80% of the face value or 92% of the face value. Some such part is what we are calling as the recovery rate. So the recovery rate changes based on the seniority. So senior, subordinate, mezzanine, they have different kinds of priorities. Similarly, secured, unsecured versus secured, they have different levels of recovery rate. And the recovery rates, they are very much dependent on the default rate. Because if the default rate is much higher, there is a good possibility that the recovery rate is much lower and vice versa. Because if you look at it like this, if there is a bad year for defaults, right, which means default rates are much higher, and that would generally result in a low recovery. Look at two examples which I have cited here. Okay, let's say in a particular year default rate is high. So the more common cause that I can talk about is economic conditions are poor. That's the reason people are not able to pay. And when economic conditions are poor, average recovery rate is low, which means I can't get my full money back, even the recovery rates also will go low. Similarly, look at from a mortgage perspective, default rate increases. Lot of people stop paying on their loans. So once they stop paying, lot of foreclosures are going to happen. So the bank has to sell so many assets because for many of them the loans are not getting paid on time. So too many foreclosures resulting in too many houses being offered for sale, which is coming out in a very heavy decline in the housing prices because lot number of houses are coming for sale. So resulting in a big drop in the prices, which means the recovery rates are falling drastically. So what we could see is a good relationship exists between the recovery rates and the default probabilities. Now let's look at the different mechanisms of estimating the default probability. One initial mechanism that we will look at is estimating them from the bond yield spread. So whenever we talk about a spread, it is the excess of the promised yield, whatever this bond is yielding, over the risk-free rate. So in addition or in excess of the risk-free rate, what is the yield this bond has promised to give? And that excess, we are trying to visualize it as a compensation for the possibility of default. So the higher is the yield, the higher is the excess of it over the risk-free rate, the higher I am looking at it as a compensation for the possibility of default. So whenever I am talking about for a T-year bond, if I am saying that the spread is ST per annum, and during this period, if I am saying average hazard rate is lambda t. So what we are saying, lambda t is nothing but, see, if you look at the average loss is nothing but, okay, average hazard rate. And in case there is a hazard, if I take out 1 minus r, this is the amount of loss. So average loss is going to be this much. And at the same time, we are saying that the average loss is a compensation that is built into the spread. So I can equate these two things, which means I can very well compute the average hazard rate as the spread divided by 1 minus the recovery rate. Now, if I look at this numerical, try to solve this. Okay, suppose the 1 year, 2 year, 3 year bonds issued by a corporation. So 1 year, the basis points are 150. For a 2 year bond, I am talking about 185, 180, sorry, 180. And for 3 years, I am looking at 195 basis points above the risk-free rate. Recovery rate is 40%, right? Recovery rate is 40%. Find the average hazard rate for each of the years. So I could talk about, so these are the spreads, right? So the spread of this much, and this is the recovery rate. So I could talk about the hazard rates. This is the time period, and here I am talking about the basis points above the risk-free rate. So which is what actually we call it as the spread. Let me call it spread directly. Right, so from here I should be able to find out the average hazard rate. The average hazard rate I can very well find out as the spread divided by, so the spread divided by 1 minus R. So spread, let me take it as in terms of percentage. I divide it by 1 minus the recovery rate. So this tells me that the average hazard rate is 2.5, the average hazard rate is 3, and average hazard rate is 3.25. And obviously this is the average for 2 years. So year wise hazard rates, if I am looking at, for the first year I'll take it as 2.5, but for the second year the average is 3. So it is coming out like 2 times 3 minus 2.5. So for the second year alone it is 3.5, and for the third year it becomes 3 times 3.25 minus 2 times, or probably minus, okay, 3 times 3.25 minus the summation of all the hazard rates till date. So this says that the third year alone, between second and third years, the hazard rate is 3.75. Between 1 and 2 years, the hazard rate is 3.5. And between 0 to 1 year, the hazard rate is 2.5. So that's the way we are able to estimate the hazard rates, right? And how do I match these bond prices? We can choose the hazard rates so that they match the bond prices accordingly. So then it goes similar to the bootstrap method for calculating the zero coupon curve. Like the shortest maturity bond, I'll take T1, like 1 year bond. I'll calculate the hazard rate at time T1. Then I take the next shortest to calculate the hazard rate between T1 and T2. So I go with that kind of a mechanism and I compute the hazard rates for each of the periods. Let's look at one numerical example which can give us that kind of a comfort level. Suppose the risk-free rate is 5% per annum. Okay, I'm looking at risk-free rate 5% per annum continuously compounded for all maturities, 1 year, 2 year, 3 year bonds have yields. So 1 year yield is how much? 6.5%. Alright. 2 year bond yield is 6.8%. 3 year bond yield is 6.95%. Alright. So these are the yields of these three. We suppose that each bond has a face value of 100, face value 100, alright. Semi-annual coupon at the rate of 8% per year. Coupon 8% semi-annual with a coupon having just been paid. Find the price of the value of the risky and risk-free bonds. First, let's find out the value of the risky and the risk-free. Okay, so I'll go with the first one first. I'll go with the bond 1. Right, for the bond 1, the coupons that are going to come out for so I can find the price going with a yield of 6.5%, right? So the price of it I can very well find out as the present value formula rate. If I am taking the rate to be 6.5 by 2, NPR, number of periods, okay, 2 periods is what the payment is happening. PMT is 4 and FV is 100, which is resulting in a price of 101.43. So this is the price that is coming. 4, and probably if I'm going with continuous, because this is a continuous compounding, let me not use this formula. So the price will come out as 4 divided by e to the power of RT, which is 0.5, plus 104 divided by e to the power of RT is 1. So the price of this comes out to 101.39 if I am doing a continuous. So this is the risky price. Risky price. But if I do the same as risk-free price, I get it as 4 divided by e to the power of R by 2 times 0.5. Oh, here R is what? RT. So I don't need a by 2 again here. So this is becoming 101.33. Whereas if I am going with the risk-free, 4 by e to the power of RT plus 104 by e to the power of RT. So this is giving me 102.82 and this is 102.33. So probably if I am doing both of them in a general format, so the excess here is coming out to be around 102 minus 101. So 1.5 is more and more associated with the amount of risk that is coming out. That is what is corresponding to the spread. So let me do the same work for bond 2 as well. So if I find the risky price, it is nothing but 4 by e to the power of RT.5 plus 4 by e to the power of RT, which is for 1, 4 by e to the power of r 1.5 plus 104 by e to the power of r2. So this is giving me that the present value is around 101.99, whereas if I am going with the risk-free price, it is 4 by e to the power of r.5 plus 4 by e to the power of r1 plus 4 by e to the power of r 1.5 plus 4 by e to the power of r2. So this is around, this is 104. The last one is 104 resulting in 105.52, and now comes the excess. In this case is 105 minus 101, making it 3.52. So this is what is the excess in case of bond 2. Similarly, if I go with the calculation associated with bond 3, I can find the risky price, which comes out as 4 by e to the power of 6.95 times 0.5, 4 by e to the power of 6.95% times 1, 4 by e to the power of 6.95% times 1.5, 4 by e to the power of 6.95% times 2, 4 by e to the power of 6.95% times 2.5 plus 104 by e to the power of 6.95 times 3, resulting in a risky price to be equivalent to this much. And if I have to look at risk-free price, probably I'll copy the same formula and I say that the risk-free price, instead of wherever B11 comes, I'm selecting B8. So this is what is happening for my risk-free price. So the risk-free price is 102.08, which means the excess is coming out in this case as this much. Okay, so these are the excesses that have come out. Right, this excess is corresponding to the spread. Now this numerical is saying this excess that got generated is corresponding to the spread. Alright. So find the prices of the value of the risky and risk-free bonds we have found out. Assume that the defaults can happen only at the midpoints of the 6-month intervals. So the default periods, is either after 3 months, which is 0.25 years, or after 0.75 years, or probably 1.25, something like that. Recovery rate is 40%. Right, so this is one more information that we have. Find the hazard rates for each of the 3 years. Now I have the spread. Right, now I have the spread, which is what is indicated. So this is the risk free. Alright, so this is the risk free price. So let me do for the bond 1 itself. All I really want to look at is, because we are assuming that the default period is 0.25, so after 3 months, so I'll say after 3 months, risk free price. what is the risk-free price after 3 months? 4 by e to the power of, I'll take it as 5% times 0.25 plus 104 by e to the power of 5% times 0.75. So the risk-free price at that point comes out to 104.12. And if default occurs, recovery if default, we know that it is 40. So we are talking about loss or present value of loss if default occurs, which is nothing but 104 minus this, working out to some 64.12. And this is at the end of 3 months. So I can even take the present value of this by discounting this particular number. By discounting this particular number, e to the power of, or probably I'll say divided by e to the power of RT, 0.25, which is working out that it is around 63.33. So similarly, I'll do the same work for after 9 months. If I want the risk-free price, what is it, the risk-free price? Now that one coupon is paid, only it's the final amount, 104 divided by e to the power of r, and there are 0.25 months more, 102.7. Recovery if default is 40. And so I can very well find out the present value, which comes out as the subtraction between the two divided by e to the power of r. T is 0.75 there. So this is the present value of the loss. So we are getting, in case the default occurs after 3 months, the present value of the loss is 63.33. In case the default occurs after 9 months, the present value of the loss is 60.4. Now all we are saying is, now from here I'll try to work it out. Let me take the probability of default. Right, I can go with the probability of default. So the probability of survival in 6 months, we have got it as 1 minus e to the power of minus 0.5 lambda. Similarly, survival at the end of 1 year, 1 minus e to the power of minus 1 lambda. Right, this is the probability of survival. 1 minus e to the power of minus 0.5 lambda is the probability of survival up to the 0.5 years. This is the probability of survival up to 1 year. Or 1 minus is, see, okay, if I assume the probability of survival for 0.5 years is 0 e to the power of minus 0.5 lambda, and the survival up to 1 year is e to the power of minus lambda. So the hazard between the, so the probability of default, probability of default in 0 to 0.5 years is 1 minus e to the power of minus 0.5 lambda, and probability of default in 1 year is 1 minus e to the power of minus lambda. Now I want to find out what is the probability of default between 0.5 and 1. So I'll try to take the probability of default in 1 year minus the probability of default in half year. So which works out as e to the power of minus 0.5 lambda minus e to the power of minus lambda. Right? So let me take that. Right? So and then we multiply that hazard rate with the amount, and we'll try to equate that to 1.5. So we'll take lambda to be some value. So lambda 1 Let me assume it at around 2% just for the sake of doing it. Now, what is that I'm saying? I'm saying the probability of default. So here we'll talk about the probability of default now, which will come out as 1 minus e to the power of minus 0.5 lambda. So 1 minus e to the power of minus 0.5 times lambda. So here the probability of default comes out to be this, and here we are saying e to the power of minus 0.5 lambda minus e to the power of minus lambda. So e to the power of minus 0.5 lambda minus e to the power of minus lambda. So this is working out to around 0.00. So if I convert them into percentage form, it is working out to around 1 and 0.99% if the hazard rate happens to be around 2. So from here I am trying to find out the expected loss. Expected loss is coming out as the probability of default multiplied by the present value of losses. Probability of default multiplied by the present value of the losses, giving me around 1.22. But this has to be equal to around 1.5. So let's say if I make it 2.5%, then probably it is becoming expected loss is 1.52. 2.45%, 1.49. 2.46 on an iterative basis I can very well try out. So I can look at for 2 decimals, which is working out to around 2.46%. So I say that the hazard rate corresponding to L1 is around 2.46%. Probably the same logic. Let's try executing in case of bond 2 to get a comfort level. In case of bond 2, all that can happen is the default can happen after 3 months, or it can happen after 9 months, it can happen after 15 months, or it can happen after 21 months. All these 4 places the default can occur because it's a 2 years kind of instrument, right? So I'll try to find out all these 5 elements here as well. The risk-free price, we know that we are going 3 months later. So we have 4 by e to the power of 5% times 0.5 plus 4 by, now it's not 0.5. So I'll make it 0.25. Or now that I have the price, I can multiply across by e to the power of 0.25. Now that I have the price, I multiply this price by e to the power of 0.25, which will give me 130. Point okay 4 by e to the power of 0.25. Okay, let me work it out. Otherwise, 4 by e to the power of 5% times 0.25 plus 4 by e to the power of 5% times 0.75 plus 4 by e to the power of 5% times 1.25 plus 104 by e to the power of 5% times 1.75. So this will give me the risk-free price, which is working out to around 106. A recovery in case of default is 40. So the present value of the loss is going to be the difference between the two, and the probability of loss, we know it is 1 minus, so here depends on the lambda that I am taking. So L2, let me take for time being that same 2.5%. So the probability of default is going to be 1 minus e to the power of minus 2 point minus lambda times zero point 0.5 e to the power of minus lambda t. So this is working out to somewhere around 1.24%. So the expected loss from this is working out to somewhere around 0.83. Now the same logic, if I have to do it for after 9 months, right, only these three need to be considered now, because one of that would be going off. So after 9 months, if I am considering, okay, 4, and here the last one will be 104. So the value of it is going to be somewhere around this. Recovery in case of default is 40. The present value is around 65.5. Then from here, I look at the probability, where I'll take as 1 minus e to the power of minus 2.5 times 1 minus this number, which is working out to around 1.23%, and from here comes my expected loss as something around this. Now the same logic I'll continue for after 15 months as well. So except that this one will become 104 in case of default recovery. So this is what is working out to be the value, and again the same logic, I can very well work it out. 1 minus e to the power of minus lambda times 1.5 minus, I am subtracting the probabilities of default of the previous period, coming out to this much, which is resulting in an expected loss of this. And finally, when I am taking one more, the last one, here also I am taking 104, giving me this much. This is still 40. I could very well use this one for the present value of the loss. 1 minus e to the power of minus lambda times t minus all the previous probabilities of default, resulting in an expected loss of this one. So I can very well find out the total expected loss, which will result in the summation of all these. So around 3.16, but my excess is around 3.53. So which means I may have to increase it, let's say, to around 2.6%. It's still higher. If I make it 2.7, it's still higher. Probably I should look out at 2.8. This is more or less matching. So I say that in this case, I can say that in this case, the L2, which is the hazard rate for 2 months, is working out to around 2.8%. The same logic I can go ahead in terms of, or if I want to know exclusively for the second year, so I'll take this number minus 2.46, which will give me around 3.14% exclusively for the second year. So this is the way I can very well simplify computation of my hazard rates. Okay, for the first year, I might have taken the hazard rate. I should have taken the hazard rate as it is. Right? I should not take this numbers. So for the first year, if I change it, I should not take L2 anymore. I should take the hazard the first year's itself. So instead of taking J25, probably let me go ahead in terms of taking this itself for the first years. Even here, I'll take only this one. So from here, I'm supposed to calculate for the second. So now when I'm getting it around 2.9, it's going up. So 2.82 or something like that is also up. So probably I'm still going with 2.8 or 2.81%, which is what is making my overall hazard rate for L2 get solved with this. Or even when I'm looking at yes, so I'm actually working out in terms of hazard rate in this typical manner. For each of the years, I can compute the hazard rate, multiply it with the expected loss, and that's what will lead out to calculate my overall hazard rate for year 2 as well as for year 3. So, so that's the typical way where we compute the hazard rates for each of the years. Now, if we try to dig a little bit deeper to understand this process, right, whether I have used the bond yields kind of a mechanism or I have used this kind of a matching mechanism, whatever is the kind of mechanism that I have used to compute the default probability, they are purely based on the choice of the risk-free rate. And in general, the traders use the treasury rate as the risk-free rate because in the first case here, when we have found the spread with respect to the risk-free rate. In the matching concept, we have computed, we have equated, we have found the price of the bond, first the risk-free price. So the risk-free rate has some kind of a role in these both exercises. And generally the risk-free rate that is used is the treasury rate, but we know theoretically they are very, very low to be used as proxies for risk-free rate. Now this is where an alternative for the risk-free rate is being looked at, and the credit default swap spreads, they are found to be a good substitute for credit spread. So because it does not depend in any way on the risk-free rate. And even when I am trying to find out the implied risk-free rate by comparing various instruments, we are finding that the implied risk-free rate is coming more and more closer to the LIBOR rate or the swap rate, but not closer to the treasury rate. So what has to be used as a part of the treasury rate is very important for us. The risk-free rate is very important to us. And though we talked about the credit default swap spreads, the asset swap spreads also play an important role. Because in practical, we are saying that the LIBOR or the swap rate is used as a kind of a proxy for risk-free when the credit calculations are carried out. And when I am looking at the asset swap spread, which uses the LIBOR or the swap rate, it is providing a direct estimate of the spread. Take an example. I'm talking about the asset swap spread, let's say is 150 basis points. So if the bond is selling for par, we talk about one party paying the coupon and the other party paying LIBOR plus 150 basis points. So whatever are the promised coupons, they are paid and you are receiving LIBOR plus 150 basis points. Regardless whether the bond defaults or not, I am receiving LIBOR plus 150 basis points and paying the coupon. But if the bond is selling below par, so instead of along with the paying of the coupon, even a $5 extra is also paid at the beginning. So which is as good as you have compensated for the entire 100 and received LIBOR plus 150. So which means you have received again the same irrespective of the default. Or even if the bond sells above par, okay, I am paying the coupons, receiving LIBOR plus 150. Along with that LIBOR plus 150, I would also receive that $8 additional and pay only the coupon. Even then the strategy remains the same. So that's how we can use the asset swap spreads effectively in all the possible scenarios. And now comes the next point. How do I compare the default probability estimates? A few important points here. Whatever I am computing from the historical data, which are called as real world probabilities, they are generally much less than the ones that are derived from bond yield spreads, which are called as risk neutral probabilities. We'll talk about them slightly in a slide or two later. But this is the reality. The default probabilities that I am getting from the historical data are generally lesser than those that are derived from the bond yield spread. And this difference is much higher during the credit crisis. What is the reason? There is what is called as a flight to quality. Every investor wants to hold only secured instruments. Everyone wanted treasury bonds. So the demand for other corporate bonds has declined. So obviously the bond prices have declined. Bond prices declined means the yields on the bond have increased because prices and yields are inversely related. The yields have increased, and because of that the credit spreads on these bonds have increased. The moment the credit spread has gone out, the default probability estimates have gone up drastically. So one, we see the real world numbers are much lesser compared to the risk-free world. And a few interesting points. If I am looking at the hazard rate, computing it from the bond prices, again the risk neutral. And if I am looking at the hazard rate from the historical, I see that in the first case it is very high for investment grade companies, and it is keeping on going down as the credit rating of the company is declining. For investment grade, that ratio used to be sufficiently larger. So any large percentage difference that is existing between the two, it is resulting in smaller excess return. And this is where the return is increasing, where the credit quality is declining quite drastically. So that's how we can use the historical data and the risk-free data, risk neutral data, to typically evaluate what should be the typical excess return that can come on the particular instrument. Now, if I have to differentiate between these two worlds of probabilities, the real world probability versus a risk neutral. Wherever I am doing the default probabilities or hazard rates, I am trying to imply them from the market based credit spreads. I call it as a risk neutral probability. Generally, for pricing, expected cash flows in a risk neutral world, and wherever I am doing a risk neutral valuation, discounting the expected future cash flows at the risk free rate, we are using the risk neutral default probability. And in the practical sense, we see this number would be much higher compared to the real world. And in the real world, whenever I say real world default probability, these are the numbers which are coming purely from the historical data. And if there were no expected excess return, see, generally if the investor is risk neutral, means he does not expect any kind of a higher return for the higher risk that he is taking. In that case, the real world and risk neutral default probabilities are the same. But in reality, this cannot be the case. There are cases where the investor expects higher return. Let's look at a few important reasons. Corporate bonds, illiquid compared to the treasury securities. And for bearing this illiquid bonds, the returns that are expected by the bondholders are higher. So that extra difference is resulting in an expected excess return to be higher. And if the expected excess return is higher, we are seeing that the real world default probability is lesser. Subjective default probabilities of the bond traders might be much higher. And in some cases, this is a very interesting part, the depression scenario, the possibility that the price can go down drastically. People might have created the depression scenarios with a much higher degree of probability than those which is typically represented by the historical data. And one more important thing is the default that we are talking of for the bonds, they do not happen independent of each other. There is a lot of correlation that can exist between the two bonds that are defaulting. Right? To a large extent, there could be a systematic risk. The whole system, the economy as such, plays a very critical role not just on one bond but almost for every bond. So the bond traders earn expected return in excess for bearing that systemic risk, especially when the economic conditions are very poor. Similarly, there could be a non-systematic risk also in case of bonds. In the equity world, that may not be existing, because we say the equity investors can diversify it by creating a portfolio. Whereas in case of bond, that is not that possible. One reason, bond returns are highly skewed, whereas for stock returns we make an assumption they are very close to normal. Whereas bond returns are highly skewed with a limited upside. So they become very difficult to diversify away, which means the bond traders need to be compensated with a higher return even for bearing this non-systematic risk also. So that's the reason we see a big difference in real world versus risk neutral probability of default. And if that's the case, which one should be used? So there we say it depends purely on the purpose of analysis. If my objective is valuing credit derivatives or estimating the impact of the default risk on the pricing valuation world, it's better to rely on risk neutral default, because whenever we are using the word pricing valuation, we are talking of expected present value of the future cash flows. And whenever we are using the word expected, we are going with the risk neutral valuation itself. But when we are doing a scenario analysis where we are looking at the potential future losses from default, there I am not looking at the expected or the present kind of a value. In that case, it's very much essential to rely on the real world default probabilities itself. So that's where I could differentiate between the usage of risk neutral default probability versus the real world default probability. Now, the next mechanism which we will look at for estimating the default probabilities is using the equity prices. One reason why we are using the equity prices to estimate the default probability is it is very much understood that the equities provide a more up-to-date information, whereas the credit ratings are revised very much infrequently. Only once in a while, probably once in 6 months, once in a year, the credit ratings are revised. Whereas when it comes to the equity prices, they change almost on a daily basis, which means there is a good possibility of using them to estimate the default probability. And a research on that direction has been made by the Merton model, which assumes that the company's equity is an option on the assets of the company. For simplicity, look at it like this. A firm has only one zero coupon bond that is outstanding and that matures at time t. Based on that, look at, okay, if I am finding out V0 is the company's value of the assets today, value at time t. Similarly, equity at time 0 is 0, value of the equity at time t. T is the amount that needs to be paid at time t. And I look at the volatility of the assets and the volatility of the equity. If I am taking these numbers, look at some interesting aspects. If the value of the firm at time t is less than the amount of debt that needs to be paid. So value less than the debt that needs to be paid. So the company is going to default because it does not have the sufficient fund to pay the debt. So the equity holders in that case are going to get 0. Whereas on the other side, if the value of the firm at time t is greater than the debt that needs to be paid, the company is definitely doing a debt repayment, and whatever is the balance, Vt minus D, is what is going to the equity investors. So if you look at how much the equity investors are getting, they may get either a 0 if this is the situation, or they may get Vt minus D if this is the situation. Whichever is the maximum they are going to get out of these two, which is what exactly is the way I can define a call option. So equity is a call option on the value of the assets of a company with a strike price equal to the amount that needs to be paid towards the debt. So with this, I can very well go ahead and do the valuation of the equity. I can use the Black-Scholes formula, which was this one, V naught ND1 minus the present value of the strike price times ND2. And I can also find the values of D1 and D2. And here, once I do this exercise, N of minus D2 is something that gives me the risk neutral probability that the company will default on the debt. And for that, if you look at this whole stuff, I don't know what is V naught, which is the value of the total assets of the company today. And at the same time, I also don't know what is the volatility of the assets of the company today. So these two are not directly observable and I don't have the information. But a couple of important things is, if the company is publicly traded, I know E0. So which means in this expression, if I am taking E0 from the market, I know ND1, I have all the other values. The only thing that I may get is V0. So I have one expression which works out with E0 and sigma E also, which is the volatility of the equity. I can either get the historical volatility by observing the market prices, or I can use an implied volatility based on the option prices and the Black-Scholes model. So once I know this sigma E, I can very well use the Ito's lemma, which simply talks about the change in equity to the change in the value of the overall assets of the company. I can very well, and I multiply that with sigma V times V0. And if you look at this, this is nothing but ND1 because this is delta. Delta times sigma V times V0. So we have one more expression with respect to the equity and V naught as well as the sigma V. And based on these two, I should be able to find or solve the values of V naught and sigma V. And based on that, find D2, which will help me in terms of computation of the probability of default. Let's look at a simple numerical which can take us to that. The value of the company's equity is 3 million, which we are observed from the market. So E0, I'll take it as 3 million. Volatility of the equity is 80%. Sigma E, I am taking it as 80%. The debt that will have to be paid in 1 year, time to maturity is 1 year. The debt is 10 million. Wow. Debt is 10 million and the risk-free rate is 5%. Right? Now I need V0 as well as sigma V also. I require V0, I require sigma V. But let's assume some numbers. Right? For simplicity purpose, let me assume, let's say V0 is 15 million, or probably let me take it as 12 million to start with, but we'll work it out. And similarly sigma V, let me take it around 40%, some such kind of a number. Now I need to work it out using the Black-Scholes formula D1. D1, it directly tells me I can go with log S is V0 by X is debt plus R plus sigma V squared by 2 times T divided by sigma V times square root of T. Right? This is my D1. Then comes D2, which works out as D1 minus sigma V times square root of T. And from here comes ND1, which works out as the cumulative normal distributed value associated with T1. And I also get ND2, which follows a similar kind of a pattern. Okay, ND2, and I find out the value of the equity here. So this gives me the value of the equity, saying V0 times ND1 minus the present value of the debt by e power r t times ND2. So here I got the value of the equity as 322, but I need to get it as 320. Right? So this is where I can work out on a few important relationships here. The first important relationship comes from here. E naught should be equal to V naught times ND1 minus dE power minus RT times ND2, that is 1, and at the same time sigma E times E naught, right? So I need to get sigma E times E naught is ND1 sigma V times V naught. This is one more relationship that it needs to satisfy. Sigma E times E naught is equal to ND1 times sigma V times V naught. Now sigma V and V naught are the unknowns. So we will get sigma V times V naught is going to be sigma E times E naught by ND1. sigma E times E naught divided by ND1. So this is coming out to sigma V times V naught. So here we can take V naught. So we need to find out the values of V naught and sigma V. Now let's go ahead in terms of using the solver. Right, I really want to, I'll take the error. I'll take the error as E naught which we have got here minus the E naught that we have taken originally. I want this E naught. So this should come 300,000 straightforward. Right? This should come 300,000 straightforward. So what I want to look at is I want to minimize or make this error equal to 0. So I want to look at this, I want to minimize it by changing these two cells, and the kind of constraint that I want to put here is sigma V naught, right? Sigma V times V naught. Here let me do one more thing. Sigma V times V naught from this is this multiplied by this. So this is coming out. So these two should be the same. That's one rule that I can bring. So one rule that I am bringing is this value should be equal to this value. And the other rule that I am bringing is this value should be more or less equal to this. And when we are doing this, yes, so it is coming out that, oh, I should not change sigma E. I'm sorry, I have changed these two. Let me rerun the solver again. So the E naught is 3 million, and we have this as 80%. Now I want to minimize this error by changing these two. Okay, let me, yes. So let's say here it is coming out that this is V naught, this is this sigma V. But what we are seeing is E naught has come to 300,000. So E naught is matching here by changing V naught. But when I am taking this as the V naught, I have to change the sigma again so that these two numbers have to match. But here this is not occurring. So if I try simplifying the stuff, let me try. Or if we are looking at theoretically solving, sigma E naught is this much. So sigma V times V naught is equal to sigma E naught by ND1. So we know that sigma V times V naught is going to be some number. So from here I should be able to find out my V naught. So we can eliminate V naught or probably sigma V. One way is wherever I am getting, okay, one way we can try out is sigma E naught is equal to ND1 times sigma V times V naught. So wherever we are having sigma V, we can talk about sigma E times E naught divided by ND1 times V naught. So that is what we can replace with sigma, that is what we replace in place of sigma V. So one way I can look at is sigma V. Using this expression, what I am going to do is I'll take it as sigma E times E naught, sigma E times E naught divided by ND1 times V naught, V naught times ND1. So this is giving me a circular reference, and I'll try to address this circular reference by putting a kind of a looping. I do this looping, get the circular reference handled, and I think now we are getting closer. Now this is telling me that this is what is my V naught, this is what I am going to my sigma, and what I also require is my E naught. Now I'll do this maximization where this should be equal to 300,000. Now what I'll do is I'll do a what if analysis, goal seek by setting this particular value equal to 303 million, and I would like to change the V naught accordingly. And probably let it work out. Yes, it did not find a much better solution. So there is some amount of a V naught that it is working out. Sigma E divided by ND1. And what we are simply saying is V naught so in place of sigma V, we have substituted that particular number. V naught ND1. So whatever I am taking as V naught ND1 minus DE per minus RT ND2. This is what is the equity. Now we are trying to make sure that this error is the minimum most possible. This error is the minimum most possible. I'll only change this. And I don't want any of these things to be dictated here. When I solve this, okay, so let me, for the time being, let me set it to 12 million. And sigma V B37 times B36 divided by V naught times ND1 log S by X Alright, so we have the sigma V that is coming out here as sigma E times E naught by ND1 times V naught, and for that I require ND1 again. So there is a kind of an iterative looping that is coming out. Right, we can use these two expressions, ND1 sigma E times E naught and D1 times sigma V times V naught. And probably what we can otherwise do is we'll try to express V naught as sigma E naught divided by ND1 times sigma V. Let's do that. So if I assume sigma V to be around 40%, now here my V naught will come out as sigma E times E naught, sigma E times E naught divided by ND1 times ND1 times sigma V, sigma V times ND1. Okay, let's say this is my V naught here. So from here I have computed the D1, D2, ND1, ND2, and we have got the value of E naught here. Okay, but I want this E naught to be around 256. Now what I want to do for that, I change the sigma V naught, let's say, to 50%. I'm getting this value to be much higher. So I change this to 20%. I get this value very close. Right? If I'm making it 20%, I'm getting it very close. I'm making it 50%, 15%, it's going slightly again on the higher side. So 18%, again the value of the equity is around 4 million. 20%, it is 3.3 million. 21%, it's coming closer and closer to 3. Make it 22%, it is coming down still. So I make it 21.5%, still slightly down. 21.4%, still slightly down. 21.25%, more or less coming closer. Which means I could have used this to say that this is the value of my equity. 21.25% is the sigma V. This is the value of the equity. And based on this stuff, I'm trying to find out this is ND2, and the probability of default is 1 minus ND2, comes out to around 12.76%. Right? And now you can quickly check E naught into sigma E naught is this much, and ND1 times V naught times sigma V naught also should come closer. So these two are coming more or less closer. So that is one relationship that is getting satisfied, and we are also getting E naught to be more or less equal to the market value. So probably the better way to do is assume some sigma, use that sigma to work out with respect to V naught, and then do it in an iterative fashion. So it can solve the numerical quite comfortably for us. So from here I can find out the probability of default is around 12.5%, and I can find the expected loss and thus the recovery rate as well. Once I know that this is the probability of default, I can very well go ahead in terms of finding out the expected loss. I can find out the expected loss as well as the recovery rate. Probably from here, let's say this is, or we will directly do the solver data analysis, or we'll directly do the what if analysis part now, where I would like to make this value close to 3 million, and I would like a little bit of change on sigma V. Yeah, things are not improving that heavily, but this number, no, it's not worth doing this exercise. So probably I can very well go ahead with just playing at around 21.24. 299, still 21.23 is making it. Oh, probably it's better I leave it here, which means 12.7% happens to be the probability of default. Now what is that I'm saying? From here I'll find the market value of debt, which is nothing but the value of the firm minus the value of the equity. So this is telling me this is the market value of the debt. But risk-free value of the debt. risk-free value of the debt, if I take this and I discount it with the risk-free rate for 5 years, or this is a 1-year instrument, so I discount it by 5%, so it's going to be 951. So which means I could talk about the expected loss. The expected loss, we are getting it as the difference is here, and expected loss percentage. If I am saying the expected loss percentage, I am dividing it as a proportion of the risk-free value. So I am getting it somewhere around 1.2%. 1.23% is the expected loss percentage. And so this is the expected loss percent, and we know that expected loss is same as probability default into 1 minus or loss given default or 1 minus the recovery rate. So based on this, I can find out 1 minus recovery rate as the expected loss by probability of default, and so from here I can get recovery rate as 1 minus of, right, 1 minus recovery rate is expected loss by probability of default. So 1 minus of expected loss divided by the probability of default is telling me that the recovery rate is somewhere around 90.32%. So this is how from the Merton model I can find out, one, the probability of default, two, the expected loss percentage, and finally I can even compute the recovery rate as well. So that's how we can use the equity prices to estimate the default probabilities. And today we could even see that there are a lot of extensions that are generated on the top of this. It assumes that the default occurs wherever the asset falls below a particular barrier level, or even if there are payments that are required to be made not just at one single point in time t, but even across the entire interval also. There are models that can help us in doing it. And what we really need to understand is this kind of a Merton model produces a good ranking of the default probability. So irrespective of whether I am using a risk neutral or the real world kind of probabilities, the ranking will still remain the same, which means the comparison of which one is more severe compared to the other can quite comfortably be done through this approach. So that is where we are using the equity prices to estimate the default probabilities of the bonds, right? Now we will move from the credit risk in the typical bonds and finding out the probability of default kind of examples to what is the way the credit risk is present in derivatives transaction. So just to understand a little bit, any derivative transaction which is bilaterally cleared means between two parties, it is governed by an ISDA master agreement. ISDA is an organization, International Swaps and Derivatives Association. They have a master agreement. Different provisions are there as a part of the master agreement. So one thing that it contains is the circumstances when we are talking an event of default. So a few things that could be very clearly mentioned: failing to make the payment on the outstanding derivative transactions whenever it is due, or if one party requires a collateral, failing to post that collateral as and when required, or a company declaring bankruptcy, or for that matter any other definition of default can be specified as a part of the master agreement. And there could be a provision of what we call as netting. One of the important provisions for derivative transactions, So what this netting says is, when a company has defaulted, let's say A has got into a transaction, or not just one, let's say 10 different transactions with B, and let's say A has defaulted. So what it says is, all the transactions it has with B will be treated as one single in the event of default, whether it is for calculating the collateral or for finding out how much is the claim that has to be made in the event of default. There is a netting out of the transactions with the same party. And the other side, especially if A has defaulted, B is having all the right to terminate all the outstanding transactions that are there with A. And if we look at from the credit risk perspective, there are two different circumstances where there could be a loss to the non-defaulting party. Look at it like this. Okay, these two have got into a transaction. A has defaulted. If B's value is positive, right? If B's value of the transaction is positive and it is greater than whatever is the collateral that is posted by A with B, so for that additional amount, B is losing. Because in this case, B is acting as an unsecured creditor for the uncollateralized value. So this is one place where B can lose. Similarly, even if B is having a negative and B has posted some collateral with A, but the collateral that is posted is greater than this amount and this party has defaulted. So the excess by which the collateral is more than the negative value here, that is contributing to the loss of B. So B could really lose in these two circumstances. So in terms of pricing, both these things need to be taken into consideration. B defaulting as well, B's value is positive or B's value is negative. In both the cases, there could be a possibility of loss that could be suffered by B in case A has defaulted. Now, this is where we use two important terms, just trying to introduce them to you: CVA and DVA, credit value adjustment, debit value adjustment. So, what is the present value of the expected cost to the bank if the counterparty defaults? How much of loss needs to be borne by the bank in case the counterparty is defaulting? That is what we call as the credit value adjustment. And if the bank is defaulting, how much of loss need to be borne by the counterparty is what we are calling as debit value adjustment. From the bank's perspective, probably this is more positive because I don't need to pay. If I am defaulting, I don't need to pay my counterparty. So some payments are getting avoided. So in some cases it's a benefit to the bank, but it's a loss to the counterparty. So the DVA is going to be a kind of a positive value to the bank, whereas CVA is because of the default of the counterparty. So it's going to be a negative value to the bank. Now, the way I look at, if there are different kinds of transactions and let's say n different periods in which the payments need to be made, VI is the present value of each of the payments and QI is the risk neutral default probability associated with each of the payment. Then, so the risk neutral default probability of the counterparty, VI is the present value of the amount which the counterparty needs to pay to the bank. So the sum product of all of them is going to give me the CVA. Similarly, the risk neutral default probability of the bank to the counterparty and the present value of the amount that the bank needs to pay to the counterparty in each of the different periods. I multiply the two and add up across for the n periods of the life of the derivative. That is what we are calling as the DVA. So we have a debit value adjustment computation, we have a credit value adjustment computed. And we also need to compute the no default value under the assumption that neither the counterparty nor the bank is going to default. and that is what we are calling as the value of the derivative under no default. So value of the outstanding transaction, assuming either of the parties can default, is coming out from the bank standpoint. I compute it as the value without the default minus the CVA, because it's going to reduce the value to the bank. It's going to be a cost to the bank, plus the DVA, it's going to be a benefit to the bank, right? So, and from there, the probability that the counterparty will not default by the time I can very well use that e to the power of kind of an example minus STI times TI by 1 minus R. STI is working out to be the spread at each of the points times TI divided by 1 minus R is working out to be the probability that the counterparty will not default by time TI. Then, how do I mitigate this credit risk? There are three major mechanisms that we can think of, though there are so many. One is a netting. Let's assume that there are three uncollateralized transactions with the counterparty for a bank. In one of them, the bank is having a positive value of 10 million. In the other trade, it has a 30 million, and in the third one, it has a 25 million negative. Now, if there was no netting, the exposure to the bank was 30 on the first, 10 on the first, 30 on the second, and 0 on the third. Overall, making the net exposure as 40 million, which means it's nothing but the maximum of the value comma 0. So this is where I will get the total as 40 million. But if I am doing the netting, I'll first add up all of them. 10 plus 30 minus 25, 15. So I'll make this as the maximum of 15 comma 0. So the exposure is just 15 million because of the netting. That's what is the way I can mitigate the risk, and it can reduce the overall risk in the position. The second is collateral agreement. I can collect the collateral either in the form of cash, which earns interest, or some marketable securities. If the marketable securities are being kept as a collateral, then there is a possibility that the value of these market securities can be fluctuating. So depending on the volatility that is associated with these marketable securities, there is some kind of reduction in the value for the collateral. So if the marketable security is worth 120 million, I may accept it as a collateral only for 100 million, reducing it by, let's say, 16 to 17%, and that is what I am calling as the haircut. So depending on the volatility that is associated with the marketable security, I can reduce the market value of the latter to calculate the cash equivalent for the collateral purpose by applying what is called as a haircut. And the good thing about the collateral agreement in a derivatives transaction is, if one party has defaulted, the non-default party is entitled to keep the collateral that is posted. So there is no scope for any kind of legal, though those proceedings will typically take a longer period, but here the possibility is the non-defaulting party can very well keep the collateral. The third way in which the risk can be mitigated is by using a default downgrading trigger. So here we are comparing with a credit rating. If the counterparty's credit rating falls below a certain level, let's say I talk of the investment grade rating. If the counterparty's credit rating falls below a certain level, now the bank will have the option to close out all the outstanding derivatives at the market value. So it doesn't need to continue all the trades in the future. It need not wait until the default to occur. As a precautionary step, it can very well close all the existing transactions with the counterparty. However, if this drop is a gradual drop, it is fair enough. But if there is a kind of a big jump, let's say from AA rating it has gone to default, probably there is nothing much this downward downgrade trigger also can do, right? And if a company is having many downgrade triggers, not just with one, with multiple counterparties, then the chance of protection to these counterparties is going to be very, very limited, because if the bank defaults, then probably you could see that all the transactions are getting knocked off, and the bank may not get any kind of a benefit out of that process. And even if the counterparty is defaulting, if there is a kind of a chain that is built in, the bank might lose very much heavily. Let's take one good numerical to try to understand the CVA computation process. The black shows Merton price of a 2-year uncollateralized option. Okay, first one is a simple one. 2-year. So if I am taking T, it's a 2-year period. The option price, the option premium, I am calling it $3. 2-year zero coupon bond issued by the company selling the option have a yield 1.5% greater than the risk-free rate. So the spread is 1.5% more than the risk-free rate. Find the value of the option after considering the default risk. Now, which means I can very well, so this is under the risk-free rate. So after credit risk, if I want to find out the option premium, it is nothing but 3 divided by e to the power of RP. So which works out to me at around 2.91. This would be the value of the option after considering the credit risk into picture. This is a simple numerical to work out. But yes, let's look at this. This is more interesting. A bank has entered into a forward contract, buy 1 million ounces of gold, right? 1 million ounces of gold. So quantity we are talking about 1 million from a mining company in 2 years for 1500 per ounce. K, which is the contract price, comes out to 1500 per ounce. The current 2-year forward price, the forward price right now is 1600 per ounce. We suppose that only 2 intervals, each 1 year, are considered in the calculation of CVA. The probability of a company defaulting during the first year is 2%. The probability of the company defaulting in the second year is 3%. The risk-free rate is 5% per annum. A 30% recovery is expected in case of a default. The volatility of the forward price of gold is 20%. Find the CVA and the value of the contract when the counterparty of the default are considered. So right now the forward price is this much, whereas the agreement is to buy this at 1500. So from here I should be able to find out the Black-Scholes value. So which works out, first of all I'll compute the D1. Log S is 1600 by X, which is this. Now if you look at, this is the forward and K is also for the forward itself. So both of them I am looking at with respect to the forward only. So I don't require R in this case. So plus sigma squared by 2. So here I want to find out with respect to the time period 1, first of all. So here we are talking about a 1 year along with a 2 years. So we'll try to find out for the year 1. So this is where I'm computing D1 first of all. First of all, I'll do it for a period 1. I want to find the D1 for the period 1, which I'm getting as log S. Here S is F by X plus R is not existing because we are going with the forward price itself at the forward date itself. So R does not exist. I am taking sigma squared by 2 times T. So here I am looking at it at the end of the first year. So sigma times T, this entire thing I am dividing it by sigma into square root of T. Sigma times square root of T. So here comes my D1, and probably I am finding out my D2 as well, which comes out as D1 minus sigma square root of T. And from here comes my ND1, where I take the norms test associated with the D1, and I'll also get ND2 associated with this, and from here I get, right, I have ND1 and ND2. Here I get the value of the derivative through this, where I'm getting F times ND1 minus K times ND2, and this entire thing I'm discounting it to the present value. So wherein I'll get this value as e to the power of R T is 1. So I'm getting the present value here as 171. Here this is the payoff that is going to come at the end of 2 years. So probably I'm discounting it by 2 here, making it the value is this much. And F times ND1 minus K times ND2, and the D1 computation sigma root T. Okay, here I have taken D1, the one that is loss that is happening at the end of the period. So if I had taken the same like in the middle of the period rather than at the end of the period, then probably sigma squared by 2 times, and then T1 would have been 0.5 if I am assuming uniformly distributed. Then here I would have got 0.5, and here also I would have got 0.5. So giving that this is my D1, this is my D2, this comes out as my ND1, ND2, and S times ND1 minus this, giving me my value of this much. And probably if I am looking at the loss, I'll multiply this number with 1 minus the recovery rate, which comes out to 1 minus the recovery rate, which will give me that my loss in this case is working out to around 113. Even here D2 also might come out as D1 minus sigma root T. So the loss is coming out to somewhere around 92. In case I am looking at somewhere in the middle. So it all depends when I am taking it. Similarly, I can talk about D1 at the end of 2 years or during the second year period. I can take D1 and D2 the same way. So I'll compute these same numbers, log S by X and all that stuff. plus here instead of 1 I'll instead of 0.5 sigma squared by 2 times t is 1.5 and sigma root t is also 1.5. So this becomes my d1, and in case of d2 I can do this as square root of 1.5, and I'll get my nd1 as well as nd2s here, and I'll also get the value here as s times nd1 minus x times nd2 divided. So this is something that is coming at the end of 2 years. So I can do it as e to the power of rt. So this gives me the value, and when I'm doing the loss computation here, probably are using the same formula when I'm doing a loss computation, wherein I'm using wherein I am using I need to instead of this value I'll use this multiplied by 1 minus recovery. So in this case I am getting the expected loss as around 78. So from here I can very well compute the expected loss, which will come out as, okay, this is the probability of default in the first year where the expected loss is this much. This is the probability of default in the second year where the expected loss is this much. So this is what is going to be the expected loss or the cost. And now if I am looking at the present value of the forward, right, whatever the present value, if I am looking at, it is nothing but, so looking at the present value or the no default value of the forward, if I look at, it is 1600 minus 1500 divided by e to the power of rt. So this is the no default value of the forward contract, around 90.48. Now if CVA is taken into account, then the price is going to be reduced by that much. So the present value of the forward, the value of the forward contract here, by taking into consideration the possibility of a default risk, is working out to 86.27. So this is the way we are traditionally working out the impact of the CVA on the price of the various derivative instruments. So that's how we are looking at solving this kind of a numerical. Then the next concept that we are looking at in this session is the understanding of the default correlation, especially the relationship between the two companies or two bonds that are defaulting at about the same time. There are various reasons. So if I am talking about the companies in the same industry or same geographic region, generally they are affected by the similar external events, which means the financial troubles are more or less the same for them. The economic conditions could impact a lot of companies in the same country to a large extent in a similar way. So average default rates can be higher in some years, whereas they could be lower in some other years. And there is a possibility of a contagious effect. One firm defaulting, they could trigger the default for the other. So which means overall you could see that I cannot traditionally diversify the credit risk altogether. And that's one of the prime reasons I have been saying that the risk neutral default probabilities are always greater than the real world. And this concept of default correlation is very important in the determination of the probability distributions for the default loss, especially if I am looking at a portfolio which is subjected to different counterparties. And the traditionally we'll discuss about the default correlation stuff separately in a different session altogether. But just to understand, there are two major models associated with default correlation. One, we call them as reduced form models, which actually assume that the hazard rates, they follow a stochastic process and they are very heavily related with the macroeconomic variables. So this actually forms the basis for the default correlation between the two companies. It's a very mathematically attractive model, and probably it is a very clear reflection of economic cycles. They playing an important role in the default correlation. But the only limitation with these kind of models is the range in which the default correlation can be achieved is very much limited. Whereas on the other side, when I look at the structural models, which are more or less similar to that of a Merton model, where they make an assumption that the company will default if the value of the assets falls below a certain level, and the way the default correlation is induced between two companies, it assumes that the stochastic process followed by the assets of the company A is correlated with the stochastic process followed by the assets of the company B, not with the economic variable. Here it assumes that the stochastic process followed by the assets of company A is correlated with that of the B. And here I can set the correlation as high as I require. But the biggest drawback with this kind of a models are they are computationally intensive, so they take quite a good amount of time. But we'll discuss about the different models of default correlation and all in a slightly different session altogether. So this is where I would like to end this session, where we have discussed some kind of numericals and some kind of conceptual aspects regarding the credit ratings, understood the historical default probabilities, the recovery rates. We came out with the estimating default probabilities from bond yield spreads. We did a comparison of the different default probability estimates and all these things. We have used the Merton model to estimate the default probabilities. We have looked at the CVA, the computation of a CVA through a numerical example where we understood the credit risk in the derivatives transactions and just a conceptual aspect regarding the default correlation. So these are the various things I wanted to typically cover as a part of this session. Thanks a lot.